All right, everyone, I'm back. Sorry about I was away a little bit longer than I thought I was going to be. I thought I'd be back at 8:15. It's almost 9 o'clock now. I am going to take a break at 9:30. That's generally, they know that's lunchtime on the East Coast, and that's when things kind of slow down a little bit. So, these first few days when I kind of get used to, when I get into a routine, I get used to, managing not just my trading, but also, kind of the live casting software. That's going to be a little bit of a learning curve, but we'll hopefully be looking back on these videos like a year from now and just be marveled at I hope anyway, I'll be looking at these videos a year from now and just marveling at the progress that I've made. Anyway, so I took a break so I could kind of clean up the fact that charts were taking a long time to load. I don't know that they're necessarily any better, but we'll just take what is given to us. Let's take a look at where we are right now from the standpoint of markets. The Dow has recovered. Actually, pretty much everything's recovered. The Dow, the Russell, the NASDAQ, and the NASDAQ 100. The VIX is still, looks like the VIX is basically flat after having spiked. The Dow Jones was, at least futures were down 181, and look at that, and the Dow just turned positive. It's actually up $1, $2, $3. So things are turning around. Just prior to lunchtime, it'll be interesting to see what happens in the afternoon. Apple's been kind of bouncing around a lot today. It was up, now it's down. I think now it's probably down, although it's recovering a little bit, as we can see here. Autodesk is doing okay. Intel, now I was going to show you, and I still will, a trade structure for earnings. This Intel position I put on was basically an earnings play, and I'm basically going to let it expire. It'll expire for a small loss. Win is still doing strong today. Let's take a look at Win. That's much better. Yeah, we can see here. It's up 1.5% today, so not bad. It'll be interesting to see if this support holds. I'm still expecting that Win is going to trade up and at the very least fill this gap. And that is what my trade is structured on, is an assumption that Win is going to trade back up to about the 178 level. And it will probably do that before my position expires. I think I wrote out to February, so February expiration on the 16th. That's how much time I have. That last week, I don't want to be getting into that week where you start getting eaten, where time decay is basically eating away at your profit. So I'll take a look at it at that point in time. But right now it's doing okay. I mean, I'm up a small amount on this position. If I take a look at risk reward, let's link it so it pulls Win up. Risk reward. So if I'm wrong, first of all, if I'm right, and if Win trades up to about that 178 level at expiration, it's going to be about a $500, a little bit more than $500 gain. Okay. If I'm wrong, and the way in which I'm wrong is going to determine this. If I'm wrong and Win goes below, just falls through the floor and trades below 160, at expiration I'm only down $185. Okay, so 185 to 500. That's not quite 3-to-1. It's maybe 5-to-2 or something like that. If when trades at this level here, like it gets stuck at 165, which right now it's trading at, what did I say, 168, so it's right here. But if it falls back here, which is about where it was when I put this trade on initially, then that's the worst case scenario for me. At expiration, I lose like 650. So that's not, that's worse than 1-to-1 on profit on, risk to reward, which I talked earlier about how, you want to have you want to do better than 1-to-1. You want to do 2-to-1, 3-to-1, 4-to-1, 5-to-1, 6-to-1 if you can get it. That old adage that there's no such thing as a free lunch in the options market holds just as true there as it does everywhere else. So getting 10-to-1 on your money, it can be done, but it's going to take a lot of work and a lot of scanning. And in future sessions, we'll talk about how do you scan for opportunities. But we're not going to really talk about that today. Now, I talked about Apple, and about the next maybe 25 minutes, I'm going to talk about what my thinking was with Apple and how I put this trade on. Earlier in the morning, I talked about, I think that if you take a look at what Apple's doing, it's been very negative of late because of the concern about the cuts in production on the iPhone 10. And, Apple peaked at 203, and then it just started cratering from there. It fell all the way down. Oh, that chart took, okay. Again, we're victims to charts taking a long time to load, but now we have it. So, point is, from the time that Apple peaked, it's been falling down ever since, and it hit support at this 165 level, which is an interesting number because if you draw it out, it's a meaningful level. Okay. It was resistance here, and it retreated, and it shot up, and it broke through here. So now that resistance was violated. It became support about 3 days later, and it's serving as support again. Now, the iPhone 10 production cuts, what you're seeing here, this decline, okay, that's, looking at this chart, that's baked in, okay, because the fact that it rebounded off this 165 level. What that's telling you is sentiment is that even with the production cuts, the fair value of Apple as a stock is at least 165. It's at least what this level of resistance was before it broke through earlier in the history. So largely, those production cuts are baked in. Now, the proof is going to be in the pudding. When Apple reports after the bell, we're going to know, and we won't even necessarily know right away because even when the numbers come out, every company, when they do a press release, they put their best foot forward. They find the most positive metric, even if it has nothing to do with anything, to lead with. So a lot of times you'll see these spikes up because the press release pulls a fast one and fools everybody into thinking it's really a better quarter than it was. If Apple isn't able to put a positive spin on these production cuts, if they aren't able to cast a bright light or a positive light on the future, like Facebook did yesterday, then there's a very good chance that Apple is going to break through this 165. If the overall sentiment is that the production cuts are bad and actually they're worse than what we thought at first, then yeah, this will pierce below 165. and from that point, where could it go? Looking at this chart, it could probably go down as low as maybe here, about 160. Could be 157.5. Could be 155. And that probably would be a worst case scenario. But these are some key levels here where you can see support and or resistance in the stock price. My overall opinion, or my, I guess, prediction or projection, if you want to call it that, is that this move down is overdone. And with this as a backdrop behind us, whatever Apple comes out with today is going to be very positive for the stock, and it's going to cause it to rebound, probably back up to, 172.5 to 175, is what I would expect. The structure that I put on is an interesting structure. In the past, I've been a real big fan of selling volatility in the face of earnings. Now, for those of you who aren't options traders, let me explain. Okay. When the implied volatility on a stock is very high, okay, options premiums go up. If you want to buy a call on a stock, which means you think it's going to go up, it's going to be more expensive for you to buy that call when volatility is high than when volatility is down. By the same token, premiums on puts are going to be higher as well, because options are like insurance. That's why they call the price you pay for it the premium. And if traders think that there is a danger that Apple's price, that the volatility is going to blow out or is going to widen, that implied volatility is going to go up and it's going to be more expensive to buy protection in whatever form you choose to buy it in. By the same token, if you buy health insurance and in the state that you live in, your carrier has a higher claims realization or morbidity than they thought they were going to have, then what happens? Premiums go up. Well, options are no different. So if you're a buyer of options, you want premiums to go up, or you want volatility to go up, because that by itself causes the value of your option to increase. Okay. If you're a seller of premium, a net seller of premium, you want volatility to go down. And here's the reason why. Selling premium is no different than selling a stock short. I want to borrow it and sell it high at whatever the prevailing market price is today, and I want to buy it back in the future at a lower price. Selling premium is the same way. Now, one thing that you'll notice, and we'll look at it with Apple, is if you plot volatility on your charts, you'll see this happen without fail. Okay, this blue curve represents volatility. So one of the things that you notice is whenever there's an earnings announcement, okay, what happens? Volatility goes up, and then once the news is out, then volatility goes down, because what was suspected is already known. And you'll see it every time there's an earnings event. Maybe volatility doesn't go up dramatically right before, but it's been going up over time. But one thing that you know is when that earnings release comes out, volatility takes a pretty swift downturn. We've been seeing volatility increase leading up to earnings this afternoon. Okay? A lot of that has to do with the production cuts that we talked about earlier. Investors have been buying puts to protect themselves against this downfall if they own the underlying. If they don't own the underlying, then they're just buying the puts as an investment. They're banking on the stock price going down. Okay. So I've been a big fan of selling spreads, selling a put spread, which is basically buying a a put and selling a higher strike put against it. Or I'm sorry, selling a lower strike put against it. The idea is that if I'm right and the stock price goes up as a result of earnings, the value of my long put is going to go down, but the value of my short put is going to go down faster, so I can buy it back at a lower price and make overall a net positive profit. Okay, I used this structure a few years back on a Costco earnings play, and it worked phenomenally. This is when I had, really first kind of gotten into trading with spreads. Prior to that point, I would have just bought a call and hoped that the move of the underlying was more than what I paid for it in premium, for the value to go up, or when I first started trading options, I didn't understand volatility and the impact it can have on stock on the value of your position. If you buy a call going into earnings, and even if you're right, and the stock price does go up, let's say it goes up as much as the premium that you paid, you would expect to, ceteris paribus, of all things being the same, you'd expect to be flat, like you wouldn't have made any money on your position. However, it's not unrealistic to wake up and find out I'm losing money, even though they announced a beat and I paid $4 for it and it's up $4. I'm losing money. Here's the reason why. Volatility got sucked out. The news is out. All right? The need for protection isn't there anymore. The event has transpired. Okay? So volatility going down can cause you to actually lose money in that scenario. That's why I think if you're trading around earnings and you're confident about the direction it's going to go, spreads are the way to do it. If you're bullish on the stock, sell a put spread. And we'll talk about that in a different video or a different day. If you're bearish on the stock, sell a call spread. I did this with Yelp a few quarters back when Yelp had a bad quarter. And this is not an endorsement of Yelp. When I mention names of symbols, I'm not recommending the symbol. I'm just telling you what I had done in the past. Yelp had a bad earnings report. Stock price went down. The calls that I was short compressed in value dramatically because of the stock price going down and volatility getting sucked out. And I was able to liquidate that position, close that position for a nice profit. I did the same thing with Costco. It was the opposite direction. I'd sold a put spread. Costco announced a blowout quarter. The price went up. The value of the short puts declined dramatically, so I was able to buy back the overall position for less than I paid for it, so I made money on that. Also because of the fact that volatility got sucked out. Now I'm going into all of that because I'm going to talk about this Apple spread. This is a broken wing butterfly. Now, if you've traded butterflies before, if you've traded iron condors before, depending on whether you're a buyer, a seller, or premium, basically you're expecting, a lot of people do condors or butterflies because they're expecting the stock to stay range bound, or they're expecting the underlying to stay range bound. And what they want to have happen, and I'll just show you an example here. Let's just put on a butterfly, just a fictional one. Let's buy it. And we'll give this a chance to update. Okay, so theoretically, if I buy this, Feb 16, 165, 167 and a half, 170 butterfly, and I pay 23 cents for it, I'm hoping that between now and expiration, that the price of Apple is between 165.24 and 169, call it 72, okay? If it's anywhere between those numbers at expiration, I'm going to make some kind of profit. My peak profit is going to be right here at this 167 and a half-ish level, 167 and a half level. That's going to be my maximum profit, okay? That would be pure luck. So, sometimes I say it's better to be lucky than good. If I think that at expiration that's where Apple's going to be trading, then I'm going to make, if I'm right, then I make 221. Now, if I'm wrong, and Apple trades plus or minus outside of those numbers, then I'm going to make a small loss. 20 bucks on either side of that. So if I'm calculating my risk reward, and if my target is for Apple to be at 167 and a half, then my risk reward is about 10 to 1 on this butterfly, okay? If I'm right. Now, remember I said earlier 10 to 1 is kind of rare to find. In this case, you're seeing it just because the odds of that happening are so slim that it'd be a miracle just about if you did this. But point is, you have this whole range in between. So let's say you take the average of that. So half of that is, you make $100 profit. It winds up somewhere between here. That's the average. So that's about 5 to 1. Okay, that's reasonable. That's reasonable, I think. What I have done here, I started with the notion that when you're trading in high volatility stocks, like high beta names, like Apple, like Tesla, like Amazon, like Google, I mean these names that they fluctuate a lot on a daily basis, especially around earnings, then the idea is that there's this thing called a market maker move or an implied move in the options market. So let's take a look at Apple, just so you can see what I'm talking about. So Apple's at 167.24 right now. The implied move is $6.35. Call it $6.36. What the options market is telling me is that it is expecting that Apple is going to move tomorrow plus or minus $6.35. It doesn't tell you what direction, just the magnitude of that anticipated direction. It could be less, it could be more. I started with the notion that if I'm focusing on these high beta names, they usually come very close or hit or exceed the implied move. And if that's the case, then what I want to do is I want to structure a position that allows me to profit if I'm get the direction correct, whether it's up or down. Okay, that depends on how I structure this position. But at the very least, I'm not necessarily rewarded if the underlying makes that implied move, but I'm not penalized by as much. In other words, the worst case scenario for me is if the underlying at expiration trades around where it was when I put the spread on, that's my maximum loss. The odds of that happening, it can happen, but the odds of that happening are pretty slim. Okay? So let me give you a real world example. Here's the broken wing butterfly that I put on for Apple. I put it on yesterday, and I think Apple was around 167, so it was around where it is today when I put this thing on. So let's take away this butterfly and show the actual position itself. Give that a chance to redraw. Okay? So what are we looking at here? Okay? The implied move is going to have Apple go down to about 160. Hold on one second. It would be easier if I change it here. It was at 167 when I put it on. All right. Memory is that the implied move took you down to 160-ish or up to about 174. So, no, it didn't change. Technology is great when it does what you want it to. Okay, there we go. So what we're seeing, this line right here is what I bought it at. Now that would basically be, you know, the blue curve here is the profit and loss curve at expiration. The purple curve here is what is it if today's date is the first, which it is. This accounts for changes in volatility, accounts for changes in the price itself, and accounts for changes in, well, I shouldn't say price, and accounts for changes in theta burn or time value. Remember, when you buy an option, its time value is decaying. So I can model by changing the date to the 2nd, which is tomorrow, Friday. How does that change my risk curve here? And if I change it to the 3rd, which is expiration, then the risk curve and the maturity curve or the expiration curve are going to be congruent. So you can see there the purple just disappeared. Okay, let's go back to today. All right, I can also model changes in volatility, so you can see that the implied vol on these options are between 69 and 73%, 72.5%. I would not be surprised if those numbers decrease by 30 percentage points tomorrow. And the way that I can model that is right here. Adjusting volatility by -30. All right. What happens when I do that? Well, at this 167, if I were to get rid of this option today, I would be in loss at 26.45 because it's changing real time. But if that vol gets sucked out, my loss is going to be bigger. And watch this when the curve changes. Because as time decays or as vol gets taken out of the options that you hold, this curve, this risk curve, conforms to fit the maturity curve more closely. So you can expect it to go down here. If it's below, which it usually is, you can expect it to go up, though not by much because it was hugging it pretty close anyway. And over here, you expect the vol curve to go up, or the risk curve to go up to conform more closely to your maturity curve. Okay, so that's what I can expect to happen if Apple's price doesn't move at all, and just the volatility. All right, vol's gonna get sucked out, and I'm actually gonna lose more money. Now, I am not projecting that's gonna happen. I'm thinking that Apple is, depending on what is announced and how the market takes it, that it's either going to trade down close to this 160, in which case I lose about 300. So in this scenario, I'd be better off if Apple didn't move at all. Now, at expiration, I would not be, because at expiration, which is, basically at the end of the day tomorrow, I'm going to lose like 3 times that. If I'm right and it goes up, then at 174, I'm looking at about a $324 profit on this position. And if I think it's going to stay above that level all day, then I'll just let this expire, because my profit at expiration is going to be this 521. Okay, and I put this on intending to hold it to expiration. All right. Now, if I think that it's going to stick around this 167, I can always just get rid of this and lock in a lower loss than if I held onto it at maturity or held onto it to expiration. The thing I like about this structure is even if I'm wrong, my risk reward is still favorable. Look at what my risk reward is. If I'm wrong and it trades down to 160, my risk is 268 at expiration. Okay. If I'm right, excuse me, and it trades up to this 174, then my gain is 544. That's about 2 to 1. Okay. 2 to 1 is not great, but it's better than 1 to 1. It's at least a position I want to take on. Okay. It's not my 5 to 1 that I saw when I put on that Nvidia, but I'll take it. What I don't want to have happen is have it not move at all. Okay. If I were to put on just a put spread, let's say I'm mildly bullish, which is what I am on Apple. I'm mildly bullish on Apple. I'm willing to take 260 of risk to make 520 a gain, or even 732 if it blows way past 174. I would have to be really bullish to want to put on this put spread. And let me just model this real quick. Oops. Not a ratio. You don't want to do a ratio. You want to do a put spread. Take off the butterfly. This will take a minute to redraw. And you'll see what I'm talking about. Okay. Apple's not at 167. It's at 167.18 right now, so it's close. Here's what we're looking at. At expiration, if Apple's where it is today, right now, I'm basically going to break even, all right? Other than commissions, transaction costs, which I can choose to include here, just to account for that. I'm basically going to break even. Let me make sure that I'm correcting or not adjusting for volatility for illustration purposes. Okay, give that a minute to redraw. Point is, at expiration, I'm going to be basically break even, okay? If Apple trades to 174 and I hold on to this till it expires, then my gain is 108. Let's make this 7 so the numbers are closer. Then my gain is 800, 798. All right, I think I said 722 on that broken wing butterfly. If I'm wrong, my loss is even more. It's 958. Now I can adjust this. It doesn't have to be. I can do a 170. Just kind of play around with this. All right, that's better. This is closer to the kind of numbers we're looking on that Brooklyn butterfly. If Apple trades up to 174 at expiration, I make about $700. If Apple trades down to 160 at expiration, I make $560. That's basically 1-to-1. I know it's not exactly 1-to-1. It's pretty close. Okay. Here's the point. If I'm wrong and the stock doesn't move at all, which is very slim, I basically break even. If I'm right and the stock moves up, I make this much. If I'm wrong and the stock moves down to here, to the bottom of the market, to the implied move, this is how much I lose. Those are my three different scenarios. Now to calculate my risk reward, I take my worst case scenario, my best case scenario, and I apply the ratio. In this case, my worst case scenario is it trades below 167. You know, and I can adjust this. I'm not, for purpose of illustration, I'm not going to adjust this to fine tune it. This illustrates the major point. 1-to-1 on earnings is not a good, I've said this before. 1-to-1 risk reward on earnings on a coin flip is not good. Okay, 2-to-1, 3-to-1, 4-to-1. Now you've got my attention. Because if I do trades like this consistently, all right, if half my trades are wrong and half my trades are right, all right, I still make money. Okay, I could be wrong 50% of the time, but if that 50% of the time I only lose $100, and if I'm right 50% of the time, but every time I'm right I make 200, all right, when you add all that, you even all that out over time, I net $100. All right, I made money. Take out transaction costs, I still made money. That's why I don't like this structure for an earnings trade unless you're extremely optimistic, or I shouldn't say optimistic, unless you're extremely positive about what the outcome is going to be. Okay. In the case of Apple, I wasn't extremely positive. I'm mildly bullish on Apple. I believe it's overdone. I believe that when the numbers come out, what's going to come to light is that, yes, there are production cuts, but they're not as bad. We don't have to take down guidance. We still blew away our quarter, yada, yada, yada. Everybody's happy. The stock price goes up. I am mildly bullish in holding that opinion. Okay. If I'm right, I make money. If I'm wrong, I lose money, but I only lose a fraction of what I would have made if I was right. Okay. About, what did I say, 3-to-1? Oh, sorry, 2-to-1 on this one. Yeah, about 2-to-1. I'll take that bet. I don't generally like trading. Prior to me kind of coming upon, utilizing this type of broken butterfly more, I really didn't like doing earnings plays unless I was really confident in my prognosis. I was really confident on Yelp, that trade I told you about, and I was really confident on Costco, that other trade I told you about. This one, I don't know. So we'll see how this shakes out. Hopefully we'll be high-fiving each other tomorrow morning. But if we're not, I'll take my lumps. I'll put other trades like this on the future, and half of them will be right and half of them will be wrong. And because I'm trading with this edge, the odds will be in my favor, and over time I should make money. So with that, it is 11:40 on the East Coast. Traders broke for lunch about 10 minutes ago. I'm going to do the same. I will be back here in a little under 2 hours. So I will be back here at 1:30 Eastern time. I might come back on at like 1, but I definitely will be on by 1:30 when everybody comes back from lunch to trade out the rest of the day with you. All right, so have a great couple hours, and we'll see you here in a little bit. Thanks.